Good morning, everyone. Welcome to the Securities Research Weekly Morning Call. I'm Raymond. I'll take you through the market outlook, followed by Roy, who will take you through our featured company for this week, which is Parallel China Retail Trust. Alright, last Friday in the US markets, we saw the S&P 500 as well as the Dow Jones hitting fresh highs. The question that remains is whether this non-farm payroll inspired rally is actually sustainable, right? Because what we have last Friday specifically, was that jobs data actually came in better than expected, and that triggered a rally in the S&P as well as Dow Jones. But in terms of global economic fundamentals, essentially we are in a soft patch, right? We have the JP Morgan global manufacturing PMI indicating that the pace of economic activity has actually eased, right? Though it continues to expand. Still, we think that 2013 is still likely to be a year of equities for the following reasons. First, although economic activity is actually slowed, it has actually not fallen over the cliff. Second, we have tail risk actually receding. And third, we are seeing central banks such as the Fed, the Bank of Japan, ECB, as well as the Bank of England undertaking synchronized monetary easing. So all in all, we think that equities should still command a decent risk premium over fixed income, specifically your treasuries as well as your investment grade issues. Now, often we have clients asking us, whether we should sell in May. Well, you might want to take profit, yeah. But even if markets actually sell off in May, we advise our clients not to go away, because actually pullback equities will actually offer an attractive opportunity to accumulate our overweights in US, China, Hong Kong, and ASEAN economies such as Indonesia, Philippines, Thailand, and Singapore. So in the previous slide, we talked about the soft patch, and we think that the equity rally still has legs, in part due to what we mentioned just now, synchronized monetary easing by our central banks. So essentially, don't fight the central banks. Last week, it was a blockbuster week for central banks. We had the ECB meeting as well as the FOMC. So just to recap, the main points for last week's meeting were as such. So that in the ECB, Draghi hinted that the ECB is keeping an open mind on negative deposit rates, right? After reducing its main refinancing rate by 25 basis points and maintaining deposit rate at 0%. The question is whether the ECB will cut rates again. We reckon that the bar remains very high in view of the inflationary environment, right? But last week we still saw the first cut since July 2012, partly because we saw Germany, which was the most resilient economy in the bloc, actually succumbing to weakness. And we caution that even if the ECB were to undertake a further rate cut, it will not essentially boost the real economy, especially when banks are still quite cautious of lending to firms, particularly small medium enterprises, as reflected by your recent quarterly ECB bank survey. Moving on to your Fed FOMC, the May FOMC statement indicated that the pace of asset purchases could actually be either increased or decreased depending on macro conditions. So this was a new addition to its statement last week. But we think that, so in short, we think that odds of an early Fed large-scale asset purchase withdrawal have essentially reduced on the back of softer economic and inflationary conditions, as well as a still sluggish labor market. And just to recap, the Bank of Japan also intends to double its monetary base in 2 years, although there was no major new policy announcements during its late April meeting. So moving on to the US, we saw the S&P crossing the psychological 1,600 resistance to a record high, right? And on the back of better than expected jobs data. So that significantly reduced the odds of a double top, right? So we look for the S&P, we look forward for S&P 500 to remain decisively above the 1,600 level. The Nikkei and Japan markets are closed today, but for the Nikkei, the USD-JPY currency pair, the 100 level still remains elusive, but better than expected economic data out from the US could result in this currency pair inching towards the 100 level. For Japan as a whole, we are cautiously optimistic on signs of structural macro reforms as well as an economic upturn, at least based on its recent PMI readings. HSCI is still struggling to clear above the 11,000 strong resistance level. Key support will be at your 10.5K level. For the HSI, if you recall, last week's webinar we mentioned that there are incipient signs of a bullish upturn, and indeed the HSI has actually rallied quite a fair bit last week, right? And it's on track to challenge the 23,000 level. STI it hit fresh highs above 3,400 on Thursday, but retreated slightly on Friday. So all in all, we think that there could be some struggle between the bulls and bears along the 3,400 psychological level, but once it clears it, we expect the STI to possibly advance towards the 3,485 level, so long as it remains above key support of 3,250. The stock exchange of Thailand is struggling to break above 1,600. It attempted once here, and it attempted another time here. So if this week it fails to break above, then there could be a sign of a double top. Jakarta Composite Index hit fresh highs last week, hitting above 5,000 level. But as we have mentioned previously, momentum is actually easing, so we could expect the indices to actually retreat unless there's a fresh new catalyst to take it higher. For the KLCI, just a brief recap. What we see right now is that the incumbent Barisan Nasional actually garnering a simple majority at the 13th general election, but it fails to get a strong mandate, right? Which means that it fails to capture a two-third majority, and in fact, it actually performed worse than what it did back in 2008. So in short, UMNO has actually survived the 13th general elections, but the question is whether Najib will actually survive UMNO, because his leadership will actually be challenged after giving massive cash handouts, doing economic transformation programs as well as government transformation programs, and yet failed to actually garner a two-third majority. That would raise challenges to his leadership. So notwithstanding this morning's relief rally, which saw the KLCI surging, gapping up, we're actually cautious on Malaysia until there's more policy certainty moving ahead. Another risk event for Malaysia this week will actually be its Bank Negara meeting on 9 May. With that, I'll pass on to Roy for his presentation of Perennial China Retail Trust.
Good morning. Good morning. This is Roy from research. We just done our initiation on PCRT, Perennial China Retail Trust, and now I'm going to share with you the content about our PCRT. The scope of this presentation include an overview, and followed by the summary of investment merits and portfolio analysis, distribution policy and earn-out arrangement, operation outlook, valuation, then risks. Okay, PCRT is Singapore's first pure-play PRC retail development business trust. It is listed on the main board of SGX on 9th June 2011 with an IPO price of Singapore dollar 0.7 per unit. The trustees manager's objective is to return unit holders with growth in net asset value through development and acquisitions, as well as the regular distributions from rental income of its completed and stabilized, predominantly retail real estate portfolio. The investment objective is to invest in, own, and develop land, uncompleted developments, and income-producing real estate in the PRC, and may also invest in the listed securities of real estate companies in the PRC. The sponsor is Perennial Real Estate Private Limited, which is a Singapore-registered company founded in 2009 by retail real estate veteran Mr. Phua Si Guan, who is the ex-CEO of Capital Mall Asia and CMT, and he's now the current CEO of PCRT. So here we summarize the investment merits for PCRT. First, PCRT offers an investment opportunity to ride on China's long-term consumption and urbanization trend, with all the key properties located in the faster growth major second-tier cities. And all the key properties are strategically sited on cities' expanding edges with easy accessibility by subway lines. Some are already in operation and some are planned. Third, the trustee management has negotiated an earn-out deed, which allows better visibilities on the dividend return in the next following 2 years. And the leasing activities are expected to improve in the near term as the pre-leasing activities in Foshan and Chengdu Qingyang malls are progressing well, and we expect the Shenyang properties to gradually ramp up the occupancy. Last but not least, PCRT has an experienced management team. As we mentioned just now, Mr. Phua Si Guan, the executive director and the CEO of PCRT, who was in charge of CMA and CMT before, has over 20 years of real estate experience in the property investment. Okay, this slide shows you a summary of the properties, the existing properties and the growth pipelines PCRT has now. PCRT is currently holding 6 core properties, 3 of them located in Shenyang, which is the economic hub of Northeast China, and 1 is in Foshan. Foshan is a city which shares economic resource and labor resource with Guangzhou city, which is the economic hub of the South China. And there are another 2 properties which are under development, located in Chengdu city, the capital of Sichuan province. Chengdu city is regarded as the economic hub and the transportation hub of West China. And beyond the existing properties, PCRT also hosts growth pipelines in Beijing. PCRT has 10% interest in Beijing Tongzhou integrated development, and also has a growth pipeline there. And another one is the Xi'an properties. PCRT has the sponsor of PCRT has assumed an option granting role for Xi'an, which guarantee PCRT to get the asset if they exercise the option. Here's a summary for the 6 key assets of PCRT in China. As you see, the 3 properties in Shenyang has already been in operation. And note that the Longzhimeng LM offices, has just completed at the end of last year. And the occupancy rate for this one is currently still quite low. And then for the Dongzhan Mall, PCRT holds 80% in Dongzhan Mall. Dongzhan Mall is one of the largest property PCRT holds, as you can see, with regarding to the net leasable area. Dongzhan Mall has over 200 million square meters, which is larger compared to the rest of the portfolio. The rest of the portfolio, and it also has a higher stakes, 80% compared to those Trixian properties. So in our valuation, the Dongzhan Mall, which is still under development, has a significant impact. This slide shows you the on-site view for the 6 core properties PCRT is currently holding. You can see the Trixian properties on the left upper corner are already in operation, and the perennial Jihua Mall in Foshan, the one on the right up corner, is just completed and is going to come into operation shortly in this quarter. For Chengdu Qingyang and Chengdu Dongzhan malls, these two are still under development. And as you can see, the Chengdu Qingyang Mall is going to be completed in the first quarter of next year, and Dongzhan Mall in the third quarter of next year. Okay, all the 6 key properties are strategically sited at the transportation nodes and well served by the major bus lines and the subway lines. So this would be conducive to bringing in the consumer traffic. As for the dividend policy, the trustee manager commits to making contributions of at least 90% of PCRT's distributable income to unit holders in the 2011 and 2012, which has passed. And from financial year 2013 onwards, the trustee manager shall make distributions of at least 50% of PCRT's income from its completed and stabilized assets. In 2011 and 2012, PCRT had made these dividend distributions of Singapore dollar 2.35 cents and 3.86 cents, equivalent to a dividend yield of 5.3%, which is an annualized figure for 2011, and 6.83% for 2012. And despite we said that the 50% minimum payout, the trustee manager actually targets to pay out the same level of dividend in 2013 and 2014, and the targeted amount is fully covered by the earn-out amount, which is an income support, and we'll provide provide more details later. But we do alert that the dividend paid in 2011 and 2012 are heavily financed by the earn-out arrangement rather than the property income, as most of the PCRT's properties are not yet stabilized. Okay, this slide introduce you the earn-out arrangement. The trustee management has negotiated three earn-out deals from the strategic partners who sell the properties to PCRT. According to the earn-out deal, the payment made to an escrow account as part of the previous acquisition consideration will be returned to PCRT subject to a cap of the pre-specified amount if the net property income from the underlying properties fail to meet some pre-specified threshold amount. So effectively, if the sold properties are not performing well, PCRT is actually effectively paying less for the acquisition of these properties. So as you can see from the figure on the right, PCRT plans to distribute RMB 227 per year in the 2013 and 2014. So sum is 454 RMB. 454 million RMB, and this is fully covered by the earn-out amount left. And as we said before, there's still some risk. If PCRT fails to stabilize the completed properties by financial year 2014, the distributable amount in 2015 is subject to a decline, and the magnitude of the shortfall would be depending on the leasing performance. So this slide shows you the projection of our estimates on PCRT's net property income. As you can see from the chart on the left bottom corner, we expect the net property income to experience some staircase-like increases as the properties under development became completed and the completed properties became more stabilized. And as you can see from the third table on the right, we expect the overall yield on cost to increase all the way from 2.5 in 2013 to 8.5 in financial year 2016, where we expect most of the properties PCRT currently holding should be stabilized by then. This page shows you the debt information. Currently, PCRT has drawn 143 million Singapore dollar from a floating rate credit facility, which is gonna expire at the end of 2014. And PCRT has also issued 130 million 6.7% interest cost fixed rate notes, which is due in 2015. So the end of 2014 and the start of 2015 is expected to be an financing inflection point for PCRT. And if we exclude the non-recurring income support from the earn-out, as you can see from the table on the right bottom corner, the interest coverage ratio and debt ratios are generally weak because the debt are being drawn to facilitate the under development projects, but most of the income generating properties are yet stabilized. This slide shows you our projection for dividend and the net asset value growth. For consistent comparison, we just assume a 100% dividend payout in the 2015 and 2016. And please do note that the management commits to paying out at least 50%. So we expect the total distributable amount would experience a decline in 2015 because the earn-out arrangement expires, and the Chengdu Dongzhan Mall, which is just completed, which would be just completed by then, is not yet stabilized. But in 2016, we expect the distributable amount to regain previous levels as the Chengdu Dongzhan Mall is more stabilized. We expect the net asset value continuously accrue, attributable to the uplifts from the revaluation gain of the development completion in the next following 2 years, and as well as the organic fair value growth for the stabilized properties thereafter. Okay, so this slide is a summary of our valuation. We value PCRT's share price by revalued net asset value method and arrive at a target price of 0.67 Singapore dollar using a relatively conservative 35% discount to RNAV, which reflects its less diversified property portfolio and the fact that most of the properties are currently under development and not yet stabilized. For shopping malls properties, we are valuing using a cap rate of between 6.5% to 6.8%, which is generally aligned with the market estimates. And for Shenyang offices, we are evaluating Shenyang offices using a cap rate of 5.75%, and all the valuation are based on currency translation of 5 between Singapore dollar and RMB. So our target price 0.67 Singapore dollar indicates an 6.3 upside potential from the previous close on the 3rd of May, which is 0.63, and this is in addition to about 6% dividend yield, which is, as we mentioned, it is covered by the audit. And so in total, it translates to about over 12% potential gain. Therefore, we assign a cumulative rating. So here's the summary of the risk PCRT's valuation may face. Firstly, PCRT may experience a longer than expected gestation period. Most of the properties are yet stabilized and still under development. So 2013 and 2014 is regarded as a critical period for the management to ramp up the occupancy. And the income support from the audit would expire by the end of 2014, and a failure to stabilize the completed properties would subject the distributable amount to a further decline than our earlier projection, and decrease the investor confidence. Another risk would be the difficulty PCRT may face in refinancing. Major refinancing occurs in financial year 2014 and 2015, and a possible fair value loss in the property portfolio due to wait leasing activities could subject PCRT to a tougher term in refinancing, such as a higher interest cost. The third, China's economic growth slows down. If the economic recovery of China loses momentum, and weak macro picture and slower disposable income growth could weigh on the nation's consumption growth, PCRT, who has all the properties residing in China, and hence lack of diversification, will be fully vulnerable. Last but not least, the translation risk. Though we expect it to be relatively stable, a possible depreciation of RMB against Singapore dollar could shrink the portfolio value and haircut dividend income from a Singapore investor's perspective. So that's all for PCRT. Thanks. Okay, questions on PCRT. If they pay only 50% of their income, will they have to pay corporate tax? Okay, yes, the PCRT has to pay corporate tax, but not in Singapore. It's their joint venture in China, which pays the 25% corporate tax. And on the audit, let me see. Turn to the slides. On the earn-out arrangement chart, why is there new and additional earn-out that extends the guaranteed payout to 2014? Okay, this new and additional earn-out is also negotiated by the management who acquire when PCRT acquires the properties from the counterparty. And if I didn't remember wrong, these two earn-out is associated with the purchase of the Chengdu Qingyang or Chengdu Dongzhan, I think Chengdu Dongzhan shopping mall. So it's because this purchase, PCRT is able to negotiate for additional earn-out deed from the counterparty. And the performance of IPO portfolio tracking their forecast, the answer is no. Actually, for more details, you can refer to the complete report issued this morning by us. And here I just briefly recap. The answer is no because the three properties in Shenyang, which are included in the IPO, experiences some difficulty in the past year in 2012, because Hongxing Meikai shopping mall was a furniture mall, and it was adversely affected by the tightening policy by Chinese government on the residential market. But later they has negotiated a master lease agreement with some with the Hongxing Meikai operator, and which is managed to safeguard the occupancy rate on this shopping mall. And they are also considering negotiating another master lease agreement with some wholesaler. So this is so because of the master lease agreement, we expect the leasing to be the occupancy to be ramped up going forward. The debt selling, on the debt information, PCRT has a total credit facility of the 325, and out of which the PCRT has drawn 143 already. And as you can see on the chart here, it also shows you the usage of the planned usage for this debt. And PCRT also has a 500 medium-term note program, but till today PCRT has just issued 130 million Singapore dollar medium-term note at a fixed rate of 6.75. For PCRT, we are not recommending a buy, but we are currently recommending an accumulate because we expect the leasing activities of PCRT's current portfolio is going to improve due to the strategies that the management currently have in mind. And yeah, so it's a accumulate rating. For the Capital Mall Asia, yes, the Capital Mall Asia is the closest peer to PCRT, and our analyst on Capital Mall Asia is using a 15% discount. Yeah, but since these two properties are covered by two different analysts, we can not really compare. Yeah, but generally, we the PCRT's discount should be higher than Capital Mall Asia.
Hi, this is Brian speaking here. Okay, just a comment on CMA. In terms of our view on CMA, we having target price of $2.11, which is 15% discount to RNAV, and CMA they had rallied pretty strong last year, and now we think that the price is more or less fully valued at this stage. Although we are seeing fundamental is improving for CMA, but current price I think is close to the fully valued level. So that's why currently at this price, our target price is also having a narrower discount to RNAV as compared to PCRT, which is 35% discount to RNAV. And we will take another question on the outlook of CapitaLand. Our target price is $4.05. The rating, our recommendation is accumulate. The first quarter result was very strong in terms of the contribution from Singapore residential sales and China residential sales. And on the ground, the operation in terms of the residential sales they collected for the first quarter is also very strong, and that is following the previous few quarters of strong sales. So with these several quarters of strong residential sales in China and Singapore, we think that had laid the strong foundation for sales recognition in the for the next 2 years as the construction progress, and also a handover take place in futures, so they can recognize the sales. And the only weakness in the first quarter result was their Australia contribution, which the figures seems to be weaker year on year, but we don't have too much clarity on that because the Australian unit only report half yearly their result. So now this quarter we don't have figures from that. But bear that in mind, the other two markets, the core markets are Singapore and China, which perform relatively strong. So we are pretty optimistic about their operation. And another point is the management is having a review on their group performance, and they they will likely to announce more restructure plan in the next 6 months. We expect some divestment may take place for their non-core operation, such as, they are reviewing their Australia operation and also some operation in Vietnam, India, and some minor operation in Europe. With this review, we believe there will be some announcement on probably divestment in those non-core assets, and they are committed to improve their ROE going forward. So that is also a positive note that announced by the company.
Right. With regard to the questions on whether we expect any further run in the STI and HSI. Now, for the HSI, like what we mentioned, so long as it remains above key support at the 22,000 level, we expect the HSI to continue to run up to challenge the 23,000 level first, and if it decisively clears above that, subsequently the 23,500 level. Right? For the STI, we have been mentioning that so long as it remains above key support at the 3,250 level, although there will be a struggle along the 3,400 level, we think that the STI would still likely advance towards the 3,485 peak level. So in short, the answer for that question is yes, we think there's some run-up, there could be some run-up in prices for the HSI as well as the STI going ahead. With regard to the question of whether do we expect any retracements possibly due to troubles on the Eurozone front, I think the short answer to that is yes, there could be some pullback, right? But like what we mentioned earlier on, we think that from an asset strategy perspective, we think that equities will still continue to command a decent risk premium over your fixed income. So pullbacks will actually offer investors an attractive opportunity to accumulate our overweights on, say, US, China, Hong Kong, as well as ASEAN economies.
Okay, came back to take questions on PCRT. The cap rate of 6.5 to 6.8%, is it considered rather low comparing to the interest rate in China? Actually, this 6.5 to 6.8 is generally in line with the market estimation. We have referred to the valuation by CBRE, which is using just 6.5 for all the retail properties. And this 6.5 is higher compared to Hong Kong and Singapore, which is Hong Kong is about 5% and Singapore is between 4 to 5. Yeah, so we believe this 6.5 to 6.8 is quite in line. We don't cover this, right? Um, Comment on capital retail China comparing with PCRT. Okay, the difference, we don't have much comparison, but we think these two may not be that comparable. As PCRT, most of the properties are still under development and not stabilized. But for capital retail China, most of the properties are already stabilized.
We have a question on with regards to REITs, asking whether REITs may be affected if there's economic recovery, given that currently the recovery in interest rate. Given that interest rate will raise, and what are the impact to the REITs as they are quite highly leveraged. Most of the REITs, they are properly hedged, or they have the facilities in terms of their financing and hedge against the interest rate risk. And so for the short term, if there is increase in interest rates, these facilities shall be sufficient to protect against the impact on the interest rate costs. And in the longer term, usually based on historical trend, when interest rate rises, REITs will so-called perform better in the interest rate rising market, as the market is, when interest rate increase, that means economic outlook is improving, and that will give a boost to the REITs prices as well. That is based on historical trend. So we still expect REITs to perform well for the short term when interest rate increase, based on the overall economic outlook recovery. And there's question on Croesus Retail Trust, which is currently open for subscription. We don't have a note on this IPO offering, but based on the figures that is provided, the yield is pretty attractive at 8%, and the property currently mainly located in Japan, and they are providing stable cash flow return. That it's the stable side. We think that currently the operation is quite stable and providing good yield, 8%. So it's quite attractive in our view. But we don't have official coverage on that retail trust.
Now, Raven here. With regard to the question of what's the market outlook for Malaysia after the recent 13 general elections. Now, the thing is that although the incumbent Barisan Nasional garnered a simple majority, it failed to actually get a strong mandate, which means that it failed to reclaim the 2/3 majority. Furthermore, it actually performed worse than its 2008 elections, right? So the thing is that markets have actually responded positively. It gapped up this morning when the KLCI opened for trading. The thing is that the question is that whether is this more of a relief rally, because given that Najib, after doing so much from giving massive cash handouts, pump priming the economy, and still fail to get a strong mandate from the electorate, that means his leadership is likely to be challenged, and henceforth there's a lot of policy uncertainty with regards to the ongoing economic transformation program as well as government transformation program, which are actually key pillars of Malaysia's domestic demand. So in short, the KLCI could run up a bit in the near term, but subsequently it could stall until there's greater clarity on the policy front, at least from the new administration. Alright, with regard to the question on CityDev, we have no comment at this juncture. And if given there are no further questions, we will end this webinar. Thank you for your kind attendance, and we will look forward to see you next week again.